You've never seen interest rates like this before. Imagine locking in 5% savings before your bank account slips away. It might sound like a wild financial twist, but today we're diving into why this very moment could be the last shot at those lucrative savings. Let's explore what's happening right now and how it could affect your wealth building strategy. Right now, the Bank of England's official bank rate sits at around 4%. Just a few short years ago, interest rates were near zero, and the sudden aggressive hikes started in late 2021, were a radical response to runaway inflation that had shocked everyone. As inflation peaked in the double digits, the BOE was forced to step in hard to cool things down. Since then, with inflation gradually easing off, but still stubbornly above the 2% target, we've entered what many call a cooling rate environment, a period where the emergency peak is now behind us. Yet money isn't exactly cheap anymore. How did we get here? The journey is nothing short of dramatic. Picture an economy waking up from a long, complacent slumber, suddenly confronted with sky-high prices that threatened everyday life. The Bank of England had to act fast. They aggressively raised rates starting in late 2021 to counteract the inflation explosion. Now that the crisis has eased, they're carefully reversing course by cutting rates from 2024 up to the current 4% level. However, even with these cuts, the benefits of lower rates aren't as pronounced as they were in the pre-COVID era. This era is a sharp pivot point that demands your attention if you want to avoid common financial traps. So, what does this mean for you and your money? If you are a UK professional striving to make smarter wealth decisions, you're probably wondering if this interest rate cycle is pointing towards a final window of opportunity for that sweet 5% savings return. It's not just about the rates you earn on your cash. It's about how this rate affects your entire financial landscape. From savings accounts and mortgages to bonds and other investment instruments. Let's break it down further. When the Bank of England increased rates so dramatically, it wasn't just to scare off runaway inflation. It was to signal that high inflation wouldn't be tolerated. These actions made borrowing more expensive while encouraging a saving to some degree because rates on deposits typically rise alongside the official rate. But here's the twist. As the crisis abates and the BOE starts to cut rates, the same deposits that once promised attractive returns might see diminishing yields. Think about it. When interest rates were peaking, many savers might have grabbed onto products that promised nearly 5% returns. In an environment of rapid increases, these products were like golden tickets. But now, as the rate cuts take effect, those golden tickets might just turn into regular savings that barely edge out inflation. This transformation can be confusing. After all, you might be thinking, is my money really working hard enough for me? Now, consider the broader impact on the market. Many of you might assume that lower interest rates automatically translate to easier borrowing and a more buoyant economy. But here's a twist worth mulling over. Lower rates can also mean lower yields on what were once attractive savings products. This nuance is vital. For every pound saved with high returns, a dip in the interest rate means a noticeable dent over time in what you actually take home in real terms. Let's bring in a contrarian perspective. Often, the narrative around falling rates is that they boost spending and consumption, which in turn propels economic growth. But if you're a savvy saver or investor, you should consider a different angle. While the economy might indeed pick up steam, your financial strategy needs to account for the fact that those high yield opportunities are rapidly evaporating. In other words, banking on historically high returns might be a trap if you're not prepared for a transition to this more modest, yet still above inflation rate environment. What about the borrowing side of things? For anyone looking at mortgages or other loans, the rate movement might seem like a clear win. Lower rates reduce monthly payments and overall interest accrued on debt. However, as rates drop, some riskier, less regulated investments might appear more attractive, luring investors into chasing yield in less secure corners of the market. The same opportunistic mindset driving people toward high yield savings in the recent past might inadvertently lead them to riskier behaviors in the quest for higher returns, especially when the comfort of a soaring interest environment is lost. Imagine you're having coffee with a friend who's equally passionate about safeguarding their financial future. You might say, I learned the hard way that chasing a high yield without understanding the underlying economic shifts can lead to a nasty surprise. That's the kind of real talk conversation we need to have right now. The key takeaway, don't let the nostalgia of those 5% returns cloud your strategic planning. It's critical to dig deeper into how current policies and rate cut strategies reshape what you get from your hard-earned savings. So, what's the actionable insight for you today? Begin by taking a closer look at your portfolio. Are you overly reliant on high yield, yet potentially ephemeral interest rates to boost your savings? The shifting economic environment suggests it's a good time to diversify and adjust your strategy. Consider blending traditional savings methods with other financial instruments that can hedge against the inevitable transition in interest rates. Whether it's adjusting your mortgage terms, exploring bonds with different maturities, or even dabbling in diversified equities, your strategy should reflect the fluid nature of today's financial landscape. It's also important to keep an eye on policy announcements and economic forecasts. The narrative we're witnessing is one of significant change. As inflation eases, policy decisions will continue to evolve, shaping the interest rate environment in unpredictable ways. Staying informed means that you can anticipate changes before they hit your bank statement. Don't be caught off guard as the attractive yields of the current period begin to fade. Ask yourself, have you prepared for both the highs and the lows? Smart wealth management isn't about riding a single trend indefinitely. It's about anticipating shifts and repositioning your assets accordingly. For instance, if you have a sizable sum in a high interest savings account, consider whether locking in that rate for a period might be more beneficial, or if you should look into products that offer flexibility as rates recalibrate. This isn't about guessing the market's next move, but about understanding its patterns and aligning your decisions with long-term financial goals. For those who are more hands-on, this might be the perfect moment to consult with a financial advisor who understands these transitions. Professionals like yourself already know that every decimal point in the interest rate equation can make significant differences over time, especially when compounded across years. A seasoned advisor can help you decide whether to remain in fixed rate products, explore variable rate options, or even experiment with innovative investment vehicles that might provide more robust protection against inflation. Another angle worth considering is how this evolving rate environment intersects with other financial traps. Consider the common myth. Low interest rates mean it's a buyer's market for investments. While lower rates can indeed make borrowing cheaper, they can also mask deeper economic vulnerabilities, such as over-leverage in the housing market or unsustainable debt levels in the public sector. As interest rates drop further, these systemic issues might come to the fore, reinforcing the need for cautious, well-informed investment decisions. Visualize this: a calm lake on the surface with unseen undercurrents below. That's the current economic scenario. While the surface, represented by headline interest rates, might seem placid, beneath lie currents of shifting economic policies and latent financial risks. Just as a seasoned swimmer doesn't underestimate a serene lake, neither should you overlook the subtle financial signals that indicate broader economic shifts. By now, you're probably wondering what immediate actions can secure your financial future against these unpredictable twists. Start by recalibrating your own understanding of risk and reward. Don't just chase the allure of a 5% yield on savings. Instead, think about how those rates integrate into your overall financial health. Perhaps it's time to reassess your financial goals, reallocate assets, or even explore new financial products that are designed to perform under varying economic conditions. In summary, today's fast-changing interest rate scene is a reminder that financial success isn't about chasing the flashiest number. It's about making informed, adaptive decisions. The 5% savings opportunity might be one of the final breaths of a bygone era, but it also serves as a stark lesson in market cycles. The Bank of England's handling of inflation and its methodical shift from aggressive hikes to measured cuts underscores a central truth. Nothing in finance is permanent, and every high yield comes with a cost. So, as you sip your coffee or peruse your latest bank statement, Remember this, staying ahead of the curve means understanding that financial conditions are never static. Whether you're saving, investing, or simply planning for the future, always be on the lookout for those subtle signals that indicate a larger change is in the works. Trust your instincts, back them up with solid data, and never let a moment of high returns lull you into complacency. Before you go, here's your actionable takeaway. Schedule a review of your financial strategy with a trusted advisor and keep abreast of policy shifts that might influence interest rates. In this ever-changing economic landscape, being proactive is your best defense against falling into traps that could derail your wealth goals. Remember, you're not just managing money, you're shaping your future. Stay inquisitive, be prepared to pivot, and let this newfound understanding drive you to make smarter, more resilient financial decisions. Thanks for watching, and here's to unlocking a future where every decision you make is a step towards lasting financial security.